Hello traders, and welcome back to another video of Scalping Trader. In this video I'm going to break down a full rules-based scalping strategy that works well in the forex, crypto and stock market. This scalping strategy combines concepts of smart money demand and supply zones, and liquidity grab as entry setups. So traders, if that is something you are interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. Let's start with valid demand and supply zones. A supply or demand zones must have two important factors to call it a valid area. First, this area should form an inefficiency candlestick. An inefficiency candle occurs when the body of the candlestick is large and it is not overlapped by the previous candle and next candle of it. In such a case, a gap is created that should be filled. The second important factor to form a valid supply or demand area is that it must cause a break of structure or change of character. Let's see some examples of valid demand and supply area. As you can see, this chart shows an upward trend, so that a demand area can be identified in this part after that a BOS is formed by an inefficiency candle. Therefore, it can be said this demand area is valid because it satisfies two valid conditions. And now look at this demand area. Here you see an inefficiency candle, but after that BOS does not form. As a result, it can be said this demand area is not valid. Now an example for the downtrend. Here is a supply area that we want to check for validity. As it is clear, after this area an inefficiency candle is formed, which is the first factor of validity. And the important thing is that this candle led to a change of character. Therefore, it has the second validity factor. And after that, we see that two other supply zones have occurred, and both of them have all the conditions of a valid supply area. Traders, if the video has been interesting for you so far, please give it a like. Now let's explain the second definition of ICT used in this strategy, called liquidity grab, which is used as an entry setup. What is a liquidity grab in trading? Liquidity grab represents the sharp price movement caused by the large volume of orders. Simply, a liquidity grab is when price tries to break a swing low or swing high but fails to do so and ends up going the opposite direction. For traders, liquidity grabs can be both a risk and an opportunity. On the one hand, the sudden and sharp price movement can lead to trigger stop-loss orders, potentially leading to losses. On the other hand, if a trader can accurately predict a liquidity grab, they could profit from the sharp price movement. Let's see the real example of the liquidity grabs. This is gold USD chart in 1 hour time frame. As you can see, there is a swing low that supports price several times, but in the last time, the price falls down under this level, but fails to do so, and ends up going the opposite direction. This phenomenon, that leads to trigger stop losses, is called liquidity grab. Now let's have a recap of all of steps that are used in this strategy. First, in higher time frame, for example 1 hour time frame, we need to identify trend. Based on trend, we should detect two last valid demand or supply zones. For example, if there is an uptrend, we should identify two last demand zones, or if there is a downtrend, we should identify two last supply zones. In the next step, we need to see a swing low in uptrend or a swing high in downtrend that is broken. In an upward trend, if the break of the swing low is in the form of a liquidity grab, so that the candlestick shadows are placed in a valid demand area, we mark the highest price of the liquidity grab candle. Then we enter the 5-minute time frame. For the downtrend is exactly vice versa. In the 5-minute time frame, as soon as a bullish candle closes above the marked price, we enter the buy trade. Let's see the real examples of this strategy. This is the chart of Swiss franc to US dollar in 1 hour time frame. As you can see, the trend of this chart is upward. So we need to identify valid demand zones. We can consider this area as a valid demand. The first is that an inefficiency is formed after that, and the second is that a BOS is created. And here a swing low is broken, so that the lower shadow of these candles touch the demand zone, that we consider it as liquidity grab. In such a case, we mark the highest point of this candle, and then enter the 5-minute time frame, so that after seeing the confirmation candle, we enter the long position. If we continue the price chart, we can see another example. Here is another valid demand area, because after that, the inefficiency candle and BOS have occurred. In this situation, we should wait for a break in swing low, and if we see a liquidity grab, we go to the 5-minute time frame. By watching the confirmation candle, we can take a long position. Traders, if you like this video, please like it to show your support, and thank you for watching.